Sooner or later, investors hear the term REITs. The term itself stands for Real Estate Investment Trust, and people wonder if a REIT is a good investment for them. They want to know exactly what they are, if they should ever buy one, and how they can tell what's a good one or what's a bad one. Hello, I'm Pat Zumbush, your YouTube CFP. If these questions on REITs are questions that you have asked yourself and you want to be a smarter investor, then this video is for you. First of all, you should know that there is nothing magical about REITs. Whereas a single stock or stock mutual funds or ETFs invest in companies and share prices go up or down depending on how well the company grows and how profitable it is, an equity REIT doesn't invest in companies per se, but instead invests in real estate directly, most commonly commercial real estate like office building, cell towers, medical facilities, warehouses, etc. These REIT-owned properties then rent space to companies or doctors' offices, restaurants, etc. And the investor in the REIT makes money if the managers of the REIT bought or built the property for the right price, leased it out at the right lease rate, consistently kept the property leased, etc., etc. In addition to some other qualifying requirements, REITs are required by law to pay out 90% of their income. Under special tax laws for REITs that go back to legislation from 1960, they are able to deduct dividends paid out to shareholders as deductible from their corporate income, so most REITs pay out 100% of their income. As a matter of educational clarity, please know that I am talking about publicly traded equity REITs here. You can also have public non-traded REITs and private REITs, as well as something called mortgage REITs. Make sure you know what you are getting when you invest, as I will generally say that equity REITs that are non-public or private are not as liquid or as transparent of an investment. Now, let me use the remaining portion of this video to state 2 good things about REITs and 3 bad things. One good thing about a publicly traded REIT is that it is a really unique asset class, and thus can help in creating greater diversification in a portfolio. Typically, REITs have a non-binary correlation with stocks, meaning REITs can go up while stocks are flat, or vice versa, and thus you can rebalance your portfolio to buy high and sell low. Secondly, as a separate institutional asset class, REITs have a long-term return like stocks of say 7 to 12% per year, which is certainly better performance than cash and investment-grade bonds. Now to the negatives. First, most people don't understand REITs, and investing in something you can't understand is never good. Secondly, poorly managed REITs are the same as poorly managed companies. If you are going to invest in REITs, make sure you have broadly diversified yourself in the REIT asset class to avoid putting all your eggs in one basket. Thirdly, non-traded and private REITs sound great and are often sold as something special, but I haven't found that to be the case. On average, REITs lack liquidity, meaning you might like to get your money out, but you can't. This shortcoming was disclosed on page 29 of that 63-page prospectus, but the person promoting the REIT certainly doesn't waste a lot of breath telling you about it. Also, the general partners might not own the majority of the REIT, but they certainly control the majority of the voting power. Even if the general partners are doing a poor job on your behalf, they are still being paid for managing the properties, and you can almost never fire them or exert control. Thus, I'd conclude very few investors should do private REITs unless they really know the general partners and see proven track records. The vast majority of people would be just as well served by owning a public REIT, such as those from Fidelity or Vanguard. I would have your portfolio not own more than, say, 3 to 5% of it to keep your diversification broad. That's it for this session of 3 Minute Money. Thank you for letting me help you do wise things with your money. Pat Zumbush out.